Well, Bosun, it's an epic struggle, and it's always fun to talk about it. You know, with Samsung still being the market leader in the worldwide smartphone market, it has around about 19% market share. Apple has a bit more than 11% market share. But mind you, Bosun, this is likely not going to remain that way this year, 2017, because the Chinese are coming. Huawei, currently the number 3 in the worldwide smartphone market, announced at the Las Vegas Consumer Electronics Show that it plans to overtake Apple this year. You know, the Chinese, they not only like to buy smartphones from companies like Huawei, Oppo or BBK Communications because they are much cheaper than an Apple phone or also Samsung, but the Chinese like to buy patriotic, so they go out and buy Chinese. And this makes it very interesting this year, of course, to see whether or not Huawei and its Chinese partners and counterparts will be able to beat Apple in terms of market share. Of course, Apple remains the most profitable phone maker worldwide, given that those phones are so expensive. The profit that Apple draws from those sales remains unbeatable.
Yes, Conrad, a lot of phone struggle out there, as you put it. You talked about the U.S. war job data, what have you, earlier in our conversation. Thank you very much. I think let's leave it there for today. Conrad Bilsen, thank you very much from the Frankfurt Stock Exchange. We appreciate your time. Well, let's move things on now to the United States, where it's early morning hours, and Jill Malandrino, who is a VOA correspondent for Channels Television, is standing by early morning hours to talk to us on this very important day. As you heard earlier, the jobs data will be out in the next couple of hours this afternoon. That will be around the opening bell on Wall Street. This is a very important piece of data from the United States, and this will be the last jobs data that the Obama administration will have on the street. President-elect Donald Trump is coming into office on the 20th. Quite a very important week, in case you don't know. That's the same week that the OPEC Monitoring Committee will meet 21st and 22nd. Quite a lot to look out for in that week starting, so you need to keep your eye on that. So let's talk to Jill Malandrino now from New York City. It's good to see you, Jill. Good morning, and a very important jobs data day. This is market pointing to the jobs data on the radar today. Where's the market pointing with this very important economic data on tap?
Well, futures are pointing to a relatively flat open in front of the jobs data that comes out in just about 45 minutes. Forecasters are expecting unemployment rate giving back some of the improvement, with consensus about 4.7%. Non-farm payrolls, consensus is 175,000. They're expected to come roughly in line with November's headline. But it's not just the headline number we're watching. The employment data give the most comprehensive report on how many people are looking for jobs, how many have them, what they're getting paid, and how many hours they are working. These numbers are the best way to gauge the current state as well as the future direction of the economy.
But in terms of what the next catalyst will be for the market will chew this jobs data, then move on to the end of the week, start getting closer to Donald Trump's inauguration. What's the next catalyst? What's the stimulus for Wall Street?
Well, the S&P 500 had a pretty good start to 2017, adding to 2016's nearly 12% gain, including dividends. So the focus is going to turn to fourth quarter earnings and whether the bar has been set too high for the quarter or more likely for the 2017 outlook. Now, consensus sees an increase of 4.4% year over year. This would be the second consecutive increase in quarterly earnings for the S&P after 4 quarters of declines that began in the third quarter of 2015. Now, according to analysts at S&P Capital IQ, they believe investors are pricing in a beat for fourth quarter earnings. That in and of itself is not a problem as long as investors don't anticipate a greater than average beat. Fourth quarter earnings shouldn't rock the market too much.
Well, if you look at, Jill, if you look at what President-elect Donald Trump has been saying, first it was it was a Ford Motors with Mexico. Now it's Toyota is likely going to get slammed. So in terms of what he's tweeting and what he's saying, down to inauguration will move the market in some form of volatility. So let's tweet Trump, as it were.
Well, Trump just put a tweet out about 20 minutes ago saying that the media got the wall wrong and that Mexico is going to pay for it later. So that remains to be seen. So his policies, they remain very uncertain. There are potential effects of the rising dollar and oil prices that management teams will once again have to contend with in planning the year ahead. So I think corporate guidance will unlikely move higher in the near term and could even be reduced from the current estimate, which is standard practice, disappointing investors and potentially causing a pullback or pause in the market. Now, that's not to say the estimates can't increase as the year unfolds and campaign policies become reality. Near term, though, there could be a risk to the market, especially as we head into a potentially volatile period following the presidential inauguration, because the first 100 days of his presidency will be what we call a show me period, and campaign rhetoric will certainly be challenged at that time.
So are you preparing for the inauguration, Jill?
It's been, just like we saw with Brexit and just like the surprise win of Donald Trump, and a lot of managers are recommending this to retail investors, is don't do anything with your portfolios. This is what makes long-term averages. You have to expect near-term and long-term volatility. But if you were to have pulled out your money on February 11th last year when the S&P was down 14%, you missed that incredible run that we had for the remainder of the year where the S&P finished up about 12%. So I would recommend just keeping your money where it is and let the averages go back and forth. That's how you create long-term averages.
Okay. We are market correspondents, so we're going to sit by the markets in the studios, do what we know how to do, and let the Wall Street and investors and traders and analysts do their job. Thank you very much. Have a great day.
Thank you.
Have a great Friday and a good weekend. See you at the other side of the weekend. Gilles Malandrino, VOA correspondent there for Channels Television out of New York. Let's talk about today's trading day in Asia's markets. It's evening already, so those folks are preparing for the weekend, with most of the Japanese automakers coming under pressure after U.S. incoming President Donald Trump threatens Toyota with hefty taxes and the yen climbing against the greenback. The Nikkei stock average closed down 66.36 points, but posted a decent 1.7% gain Monday to Friday. Elsewhere, Australia's benchmark ASX 200 closed near flat at 57.55. South Korea's Kospi gained 7.17 points. In Hong Kong, however, the Hang Seng index was flat in late afternoon trade. Chinese mainland shares went down, with the Shanghai Composite closing 11.12 points lower, and the Shenzhen Composite lost 17.44 points. Moody's Investor Services is likely to make key rating calls on United Kingdom, China, and South Africa in the new year, as rising political risk and debt levels push a number of countries on a downgrade warning back to a record high. From Europe's Brexit strains and looming elections to the battles of China, South Africa, and Brazil to reorientate their economies, not to mention Donald Trump's first month as U.S. president, Moody's Investor Services face a daunting list of decisions. Moody's is due to review the UK on June the 2nd and then on September 22nd. By then, formal EU divorce proceedings should have started, and Wilson said the mood music of the talk should be enough to decide whether to strip London of its AAA decent rating. We'll talk about Nigeria's Sovereign Wealth Fund and what the NSIA chief, Uche Oji, is planning in the new year.